Hi, Steve and Sally Smith. This is Tiffany Dawson, and I am here to explain to you derivatives and alternative investments that might assist you in your current situation. So let's move on to the first one here. A protective put. This is considered portfolio insurance, which, if you think of insurance, it's a hedge against financial loss to help you protect against that, the situations that would cause it, such as fire, earthquake, depending on the situation. So, protective put is an option contract where the buyer of the contract has the right, not the obligation, to sell the underlying security to the writer of the contract. So, in this situation, you would buy the put. So, you would be the buyer of the contract and you would have the right, you would not be obliged to sell the Cornelius stock that you have. It's purchased. You purchase a put when you're expecting the price of the security, such as the Cornelius stock, to move downward. You would profit if that stock or the security that you own declines in value because you would have the strike price minus the security price minus the premium. The most you could lose would be that premium that you paid, and you would have someone to buy that stock even though the value decreased. Okay, so the advantage is that you can't lose more than the premium paid when you have the put, when you own that put. It gives downside protection, so if the value of the stock decreases, you still gain from the sale of the security. Disadvantage is that if the put option expires, you lose what you paid for the contract. If the values don't match between the assets in the portfolio and the assets controlled by the put, there's no perfect hedge. So you would still have some misrepresentation or some coverage, that lack of coverage. So example, you own 1,000 shares of Cornelius stock. The current price is $28.87 per share. So your stock is worth $28,870. The put option is available where you would, the strike price, which is the price that the seller would have, if you would have to sell, you'd be able to sell the price of the stock to would be worth 2,900 or 29,000 or $29 per share. You'd be paying for this contract of $2,700. So you own the stock, you have the option to purchase the contract for $2,700, but you'd have the right to sell your stock to the person, to the writer of the contract, for $29,000 if the price decreases. A covered call is a second option. Writing a call option is another way of saying it, or selling a call option. You gain the premium income in an involatile market. So you're looking for if the market or the value of the stock is just kind of staying level. That's where this covered call option would come into play. The seller would receive the premium. So in this situation, you'd be the seller. You would receive the premium, and it involves purchasing or owning the underlying stock. So if you don't own the stock, then you would look to purchase the stock, then also sell a call. The covered part refers to the fact that the underlying stock would satisfy the obligation to sell the stock if the stock price increases. So the advantage here is you would gain the premium income. You can already own the underlying security. Now, with a covered call, you would be obligated if the buyer of the call wants to purchase or buy the stock from you, then you would have to sell the stock. And the disadvantage here is that there is an unlimited loss potential, especially when the market is volatile, because in this situation, the stock price could increase and it could go high as it needed to. There's no limit. to how high it could go. In a normal situation, you could sell that stock at a higher price, but with this covered call, it's been limited to a certain price to this buyer of the contract. So you wouldn't have a high gain. If the call was exercised, you're obligated to sell those securities at that specific price that that contract states, which is normally higher than what you had purchased it. So for example, to mitigate your risk, you would write a call option with an out-of-the-money strike price of $30 per share. You would earn $1.80 per share in option premium. Let's translate this. You would sell the call option, so if the buyer would want to exercise that option, you have to sell the stock at $30 per share or $30,000, even if the market price rises above it, but you still earn the $180 per share. Well, yeah. So it would be, you have 1,000 shares, so it would actually be $1,800 in premium. That was a typo. I'm sorry about that. Your third option is an equity option, or equity swap. The swap means that it's an over-the-counter agreement between two or more parties to exchange future sets of cash flow while still holding on to the original assets. So the exchange is between the returns of the equity securities or the equity indexes. So for example, your future payments, let's say you have your fixed or a change depending on the changes in the interest. I'll go forward a little bit and then we can come back to this slide so I can give you an example of what this means. Okay, here's a total return equity swap that Major Lending Bank is providing. Major Bank could swap the returns of all 1,000 shares of your Cornelia stock for the return on an S&P 500 index, or it's called a SPDR ETF. Ticker symbol is SPY. So they would swap all the returns of your shares for the returns of this ETF. All right, so we'll go back here. Oh, wrong way here. All right, we're going to go back to the slide here from the current slide. So the future payments, fixed or change, they could be fixed or they could change depending on changes in the interest or exchange rates. So they could have a set amount that you would have on those future payments, or they would change based on what those interest rate changes would be. Both parties have to perform in the future, meaning they have to walk out what they said they would say they do. And the return, the swap, it's based on the return of an index. So the two sets of future cash flow exchanges as per terms of swap are traded for, could be fixed income. So one would be benchmark interest rate is an example. So again, it can be fixed or it could change. All right, so let's move to this. So the advantages of an equity swap, it can serve to convert your fixed payment into an equity index payment, or disadvantages that the net payment could be very volatile. You may not get the same amount every single time. And normally it would be, you could have a quarterly payment or an annual payment, but quarterly is more common. And so this needs to be considered because it's not for everyone. You need to understand what's at risk here. So again, we stated Major Bank would swap the returns of all the 1,000 shares of your Cornelia stock in return for the returns on an S&P 500 index ETF. Since it's a total return swap, this would include your capital gains or your losses and any dividend payments. So the principal amount that would be settled, so right now The stock is valued at $28.87 per share. That amount is $28,870. This would be your settlement. You would not have the price as far as you would have, let's say, you would have the returns of the S&P 500, but you would not be doing the returns of if the stock price would go up or down. So the settlement would occur quarterly, and that is when you'd get your payments. If there's any other questions concerning this, please feel free to ask. I would love to answer your questions, and I hope this at least provided some information for you to examine what we can do next for you. Thanks and have a great day.